A quiet change has been moving through the banking world, and most people never noticed it happen. In 2008, during the financial crisis, a small regional bank in the United States reportedly froze several hundred customer accounts overnight. At the time, officials said it was temporary, a response to unusual activity, and it would never become routine. Yet 15 years later, according to archived records and regulatory filings, freezes have become one of the fastest-growing actions banks take during periods of stress. It happens in Canada during fraud sweeps. It happens in Australia during compliance reviews. It happens across Europe during sudden policy shifts. The pattern is quiet, but it keeps expanding. Most people still trust that their bank balance will be there tomorrow. They pay their bills. They log in to check a familiar number. They expect stability. So the idea that access could be paused, even briefly, feels distant and almost unreal. But for thousands of ordinary customers in recent years, the freeze has arrived without warning. Some only discovered the issue at a grocery checkout. Others found out while trying to transfer money to a family member. A few learned about it while traveling far from home, unable to reach a support line. A retired teacher in Manchester reportedly spent 3 days trying to understand why her account had been flagged. She kept every receipt and every statement, yet she still had to wait for a manual review. She later said the most stressful part was how normal the bank staff made it sound. Like this was just another routine step. This story matters because money is not only a tool. It is security, it is independence. It is the ability to look after the people we love without interruption. When access to it can be paused with the tap of a button, the entire idea of financial freedom shifts. Have you ever wondered how a simple policy change could quietly reshape the power balance between people and institutions? And this is only where the story begins. The real story begins long before the first major headline about frozen accounts. In the late 1990s, regulators in the United States and Europe started building digital reporting systems to replace older paperwork. According to archived policy notes, the goal was simple. They wanted faster fraud detection and smoother communication between banks and government agencies. Nothing about the early plans suggested that ordinary customers would one day feel the effects. The systems were slow, they were limited. They were used mainly for large transactions and international transfers. Then a subtle shift happened in the early 2000s. Institutions began collecting far more data than before. Every deposit, every withdrawal, every online login, every card swipe. The industry called it modernization. But this new level of detail created an unexpected foundation for automatic account reviews. What once required a team of analysts could eventually be triggered by software. A former compliance officer from a mid-sized bank in Chicago reportedly recalled the early years of this transition. She said the technology was so new that even the staff were unsure how often to run certain checks. One day a single transaction would be flagged. The next day, nothing happened at all. The rules were still forming. And most customers never knew any of it was taking shape. It is easy to forget how these systems started as simple tools, not safeguards that could pause the flow of someone's life. Looking back now, it feels like the beginning of a much larger story that nobody fully understood at the time. Do you ever think about how small technical changes can grow into something far more influential than anyone expected? What happened next followed a very different rhythm. The first major turning point arrived in the years after 2010. Banks around the world faced new regulations, rising compliance costs, and pressure to automate decisions that once required human review. According to industry filings from that period, institutions processed more digital transactions than ever before, and the old manual systems could no longer keep up. So banks began relying on algorithms that flagged patterns, movements, or behaviors that did not match past customer activity. It sounded efficient. But it also meant that a simple change in someone's routine could trigger an internal pause. By 2014, several large banks in the United Kingdom reportedly introduced automatic freezes for suspicious activity thresholds that were much lower than before. A few dollars moved at an unusual hour, a new device logging into online banking, a transfer that looked slightly different from past habits. The decision shifted from a desk officer to a software rule, and customers rarely knew what activated it. Insiders later said the first signs were subtle. Call center staff noticed a rise in customers asking why their accounts were under review. Some cases were resolved in minutes. Others required documents that the customer did not expect to provide. A small business owner in Dublin recalled how a single overseas supplier payment triggered a freeze that lasted 2 days. He said the bank never accused him of wrongdoing. They simply told him the system needed time to verify the pattern. He remembered how powerless he felt, even though nothing unusual had happened on his end. Looking back, this moment marked the first real transfer of power from traditional banking judgment to automated oversight. It was the point where efficiency quietly outweighed personal discretion. Have you ever noticed how convenience often introduces new forms of control without anyone declaring it openly? What followed would make these early changes seem almost gentle. Behind the scenes, a new machinery was taking shape inside the financial system. It was not one rule or one institution. It was a network of automated checks, government requirements, and internal risk models that gradually began to work together. According to archived regulatory guidelines from the mid-2010s, banks were encouraged to tighten monitoring as transactions became faster and harder to trace. What began as a fraud prevention effort evolved into a broad system that could temporarily restrict access based on patterns alone. At the center of this mechanism was something called behavioral monitoring. It compared a customer's actions to their own history and to general profiles created from millions of accounts. If something looked unusual, the system flagged it. If the flag matched a risk category, the account could be paused automatically. Most people never saw these categories. They existed behind the login screen, invisible to the customers who depended on them. A former risk analyst at a European bank reportedly described a moment when she realized how much power the algorithm held. She reviewed a case where a woman in her late 60s had her account frozen after logging in from her daughter's home. It was a simple change in location, nothing more. But the system treated it as high risk. The analyst said she wished she could have overridden the decision instantly. Yet the process required several steps and approvals. The customer waited almost a full day. The hidden mechanism did not operate with malice. It operated with rules. Rules that kept becoming more complex as institutions tried to protect themselves from rising threats. Rules that left ordinary people in the middle. Have you ever wondered how many decisions affecting your life are now made by systems you never see and will never fully understand? These quiet shifts set the stage for consequences no one expected at the beginning. The first major consequence appeared slowly, almost quietly. In the mid-2010s, banks began freezing accounts not because of proven wrongdoing, but because of uncertainty. According to internal reports later cited by financial journalists, the number of precautionary freezes rose steadily each year. It was no longer about confirmed fraud. It was about reducing risk before anything happened. For institutions, this approach made sense. For customers, it introduced a new kind of vulnerability. One archived document from a large bank in Canada showed that account holds linked to pattern anomalies increased by nearly 40% over a 3-year period. Most cases were resolved quickly. Some were not. A small percentage lingered for days, waiting for review teams that were already handling growing backlogs. Insiders said the mood inside compliance departments shifted as well. Analysts reportedly felt pressure to err on the side of caution. If the system flagged something, they treated it seriously, even when the customer had a long, stable relationship with the bank. No one wanted to approve a transaction that might later be questioned. A man in Melbourne shared a story with local reporters about trying to send money to his brother after a minor medical issue. The bank flagged the transfer. It paused his account. He spent the entire afternoon on the phone trying to prove that the recipient was a family member. He said the hardest part was realizing how little control he had over the process. It was his money. Yet he had to wait for the system to clear him. This consequence was not dramatic, it was subtle. It was the slow realization that access to one's own funds could be interrupted by rules that were never openly discussed. Have you ever felt that a system designed to protect you sometimes creates the very stress it was meant to prevent? What unfolded next would push these pressures to a new level. The escalation began when global events placed new pressure on financial systems. After 2020, digital transactions surged at levels no institution had fully prepared for. Banks processed record volumes of online payments, international transfers, and mobile logins. Security departments reportedly faced rising alerts, and compliance teams struggled to keep up with new guidelines issued in rapid succession. The result was a tightening of automatic safeguards that touched nearly every customer, even those with stable and predictable histories. Regulators introduced additional reporting requirements. Governments requested faster data sharing. Institutions updated their internal models to detect risk in real time. Each step made sense on paper. But together, they created a system that placed more emphasis on preventing problems than on avoiding disruption. According to financial oversight reports, some banks processed millions of daily transactions through layers of automated filters that grew more sensitive each year. Sanctions added another layer. International tensions pushed banks to monitor cross-border activity more closely. A transfer that had always passed without issue might suddenly trigger a review because new policies were added overnight. A customer traveling abroad could find their card paused, not because of fraud, but because the system lacked updated location data. A shop owner in Lisbon reportedly faced a freeze after receiving several online payments from tourists during a busy weekend. The transactions were legitimate. The volume was simply higher than usual. He told a local newspaper that the freeze cost him 2 full days of business, even though nothing unusual had occurred except an increase in customers. Every escalation followed the same pattern. More data, more rules, more automation, less human judgment. Have you noticed how large systems rarely step backwards once new layers of control are added? This growing pressure eventually led to a moment where the system reached its breaking point. The breaking point arrived when the safeguards became so sensitive that normal activity began to look risky to the system itself. Several banks reportedly experienced spikes in automatic freezes during short periods of market volatility. A sudden drop in currency values, a political announcement, an unexpected economic report. Events that once caused minor disruptions now triggered chains of internal alerts. Archived internal memos from 2021 and 2022 showed that some institutions struggled to balance two goals at the same time. They needed to protect against rising digital threats, and they needed to avoid unnecessary interruptions for customers. The two priorities often collided. When the system detected unusual patterns, even if they were harmless, it defaulted to caution. This created a wave of freezes that overwhelmed review desks already dealing with tight deadlines. The most visible example surfaced in Canada during a period of nationwide tension. Banks reportedly placed holds on thousands of accounts while responding to government requests and internal risk assessments. Some freezes were linked to flagged transactions. Others resulted from precautionary checks. Ordinary people found themselves locked out without a clear explanation. It was a moment that revealed just how quickly access could be restricted when multiple pressures aligned. One eyewitness account came from a delivery driver in Toronto who described trying to fuel his vehicle before a shift. His card kept declining. He called customer service only to be placed on hold for almost an hour. By the time he learned his account had been paused for review, he had already missed half his workday. He said he never imagined that a basic purchase could be stopped without warning. That period exposed a fragile truth. The system did not fail because of a single flaw. It cracked because too many layers of caution had built up over time. Have you ever wondered how quickly normal life could be disrupted if access to your own money depended on rules you never saw and could not question? When looking back over the past 25 years, a clear pattern begins to take shape. It is not a conspiracy. It is not a single decision. It is a gradual shift that repeats across history whenever money becomes more digital than physical. The more a society relies on electronic systems, the more control those systems naturally gain over everyday life. We have seen similar transitions before. In 1971, when currencies detached from gold, governments gained greater ability to manage money supply. In the late 1980s, when credit cards became widespread, banks gained more insight into personal spending habits. In the early 2000s, when online banking took hold, institutions gained direct access to behavioral data that had never existed on such a scale. Each shift introduced convenience, and each shift introduced new oversight. According to financial historians, the pattern is consistent across regions. Whenever payment systems become faster, more automated, and more centralized, the balance of power moves slightly away from individuals and toward institutions. Not through force, through design. Every safeguard strengthens the system. Every safeguard creates another point of control. And over time, the safeguards become the structure itself. An economist in Zurich reportedly described it as a staircase. You walk up one step at a time, you never fall backwards. But you rarely notice how high you have climbed until you look down. He said this during a seminar on digital finance, using a simple example. A customer who once needed only a signature to access funds now needs approval from a series of automated checks, even when nothing is wrong. This is the hidden pattern. The more digital our money becomes, the easier it is for institutions to decide when and how it moves. Not because they intend to restrict people, but because the system depends on constant verification to stay secure. Do you think most people realize how much the logic of the system has changed, even though the technology feels seamless and familiar on the surface? This pattern has shaped the world we live in today more than many recognize. From that point forward, a deeper pattern became impossible to ignore. The long-term consequences of this pattern are quietly reshaping how people interact with money today. Most customers still see a familiar balance on a screen, yet the structure behind that number has become far more complex than it was a decade ago. Every login, every transfer, every change in spending habits passes through layers of automated checks that did not exist when many of today's retirees first opened their bank accounts. And each layer brings a new point where access can be paused, even briefly, without warning. According to recent consumer reports, complaints related to unexpected account reviews have increased across several regions. Some complaints involve delayed transfers. Others involve cards declining during routine purchases. A portion come from people who discovered their accounts were frozen after systems detected activity that did not match their usual patterns. Nothing in these cases suggested wrongdoing. They were simply caught in the tightening web of digital oversight. The consequences extend beyond inconvenience. They change the way people plan their finances. Some now keep more cash at home than before. Some diversify across multiple institutions. Others move portions of their savings into assets that are less dependent on daily banking systems. These choices reflect a quiet shift in trust, shaped not by headlines but by personal experiences and stories shared among families and friends. A retired couple in Vancouver reportedly told a local paper that they now avoid making large online purchases. A temporary freeze the previous year disrupted their travel plans and left them hesitant to rely fully on digital payments. They said the bank resolved the issue in a day, yet the memory stayed with them. It changed how they think about access, even though they have no complaints about their bank today. These long-term effects also reach into the broader economy. Small businesses increasingly report delays during busy seasons when transaction volumes rise and automated reviews become more sensitive. International travelers experience more interruptions when systems detect unfamiliar locations. Families sending money across borders encounter new verification steps that slow down what used to be simple transfers. Do you ever think about how these small, repeated experiences are slowly shaping the way people view their relationship with the financial system itself? All of these consequences lead naturally to one final question about what this shift truly means. When you step back and look at the entire story, one idea becomes clear. The world of money has become a network of systems that prioritize security above everything else. Not because institutions want to inconvenience people, but because the digital structure they rely on demands constant verification. Each new safeguard reduces risk. Each new safeguard adds another moment where access can be paused. And over the years, those pauses have become normal, even expected, in ways earlier generations never imagined. The shift is not about banks turning against customers. It is about technology changing the meaning of control. In the past, money was something you physically held. Today, money is something you access. And access depends on systems that make decisions faster than any human can. That dependence is the quiet transformation shaping daily life in modern economies. In some ways, the pattern echoes older moments in financial history. Just as the end of the gold standard redefined the value of a dollar, this new era is redefining how people interact with their own funds. The difference is that this time the change is subtle. It occurs behind the screen, inside servers, and within algorithms most people never see. So the real question becomes simpler than it appears. What does financial freedom mean when access to your money depends on a system you do not control, cannot step around, and rarely understand? The answer is not alarming. It is reflective. It invites people to pay attention to the structure holding their daily lives in place. And understanding that structure is where clarity truly begins. Thank you for spending this time exploring a story that rarely makes headlines but touches the lives of millions in quiet, practical ways. The world of money is changing, not through dramatic moments, but through small adjustments that add up over the years. And sometimes, simply knowing how these changes unfold can offer a sense of calm in a system that often feels distant. As you think about your own experiences, have you ever noticed a moment when the system behaved differently than you expected? If you enjoy stories like this, with slow, thoughtful explanations of how history and technology shape everyday life, feel free to subscribe for more. There are many more patterns to explore together. Thank you for watching and take care until next time.